Well, let's transition here to the behind closed doors. This segment, we go through different actual entrepreneur case studies that we're working with. And one thing that I wanted to highlight here is an entrepreneur. This kind of dovetails on the back of this irrevocable trust, dynastic wealth strategy, wealth transfer strategy we're talking about. So a 9-figure entrepreneur, they've got an irrevocable trust that generates about $7 million a year in passive taxable income. So again, a trust structure that's irrevocable, set up for benefit of the kids. Each year it's spitting off about $7 million of taxable income. So one thing that I want to dive into is breaking down the difference between grantor and non-grantor trust tax status. And really what this means, high level, is that when you are creating an irrevocable trust, you can choose, do you as the grantor want to pay the tax bill, the income tax bill, or do you want the trust to pay its own taxes? And so there's some pros and cons between these, and I want to kind of break down and help kind of frame that up.
And before you jump into that, for the average entrepreneur, what I usually see is they assume, well, wait a second, I put those assets in this irrevocable trust. The trust should pay the taxes. Why would I pay the taxes? Because they don't understand the benefit at first blush. So I know you're going to touch on that, but that's what I see as the first response is, well, of course the trust would pay the taxes, right? That's where the assets are.
Yep, exactly. And we'll jump into that. And so one of the things that's important to know just to set the stage here is that trusts have a very unfavorable tax bracket. So one of the why would the trust not want to pay its own taxes? For 2025, you hit the highest tax bracket, which is 37% at the federal level, at just $15,650 of income. So every single dollar over $15,650 is getting taxed at the highest marginal rate for these non-grantor trusts.
When I was a teacher 35 years ago, I would have been in the highest tax bracket if I was a trust.
I love it. So that again is if the trust pays its own taxes. Now let's flip this to if you're a single taxpayer, you're not getting to that same level of 37% taxation until you're over $626,350 of income. So just to show the disparity between single tax filer brackets and the trust tax bracket. So the whole premise here though is, okay, do I want, to your point, Jim, the trust to pay its own tax bills, or do I want to pay the tax bill for this trust? Now, generally, the math is going to tell you that if you have enough money, you want to pay the tax bill for the trust. And again, this is all income taxes. Why? The idea is that all of those assets in the irrevocable trust are going to grow and compound in perpetuity, or forever long the trust is structured, to never pay estate taxes. So that is the generational wealth money. So if I can front the money for the taxes, that means more money grows and compounds for future generations without paying any estate taxes. And so the flip side is the trust can pay its own tax bill, but if it does it, that's money that otherwise would have gone to my children or my heirs free of estate taxes. So generally, for most of our entrepreneurs who have these irrevocable trust structures, you set these up to maximize how much you're pushing down to future generations. Therefore, I would rather pay the income tax bill out of my pocket, because most likely any assets that I have left in my estate are going to be subject to estate taxes. So I want that generational wealth to just grow and compound without any income taxes as long as possible.
You made the point exactly what I was thinking earlier. You did a good job at that, because normally an entrepreneur thinks, anytime I can get someone else to pay the taxes, someone else I'm going to get to pay the taxes. Why would I pay the taxes if I have a choice? And you said it exactly right, why you would want to do that.
Yep. So for this specific client, as we just go through the case study here, that the marginal tax bill here is about $2.59 million. That's flowing through the 1041. That's the tax return, that trust file. And then that sends a K1 to the 1040. So that's how this is all connected on the back end to your tax return. There's also a 3.8% net investment income tax, also known as Obamacare tax. That's an extra $266,000. So the marginal tax bill that this entrepreneur is paying on behalf of this irrevocable trust that is set up to go to the three kids is $2.86 million. So the entrepreneur is paying essentially $2.86 million of his own money to pay the income tax bill, and that's $2.86 million that essentially gets to grow and compound in this irrevocable trust for the kids. And so we've got a chart that we're going to throw up here that just shows you, hey, if that money, $2.6 million, is the annual tax savings, and that grows and compounds at 8% per year for 20 years, let's assume that's how long the entrepreneur has till he passes away, you'll see that the difference here, or it goes from $52 million to $119 million. So that's the difference. You can do the quick math there. It's $67 million of incremental wealth that is created by, again, the entrepreneur paying that $2.6 million million tax bill per year.
That's powerful. Something else that we see sometimes in this scenario is a more advanced strategy. When the grantor is tired of paying the tax bill, sometimes they'll put the assets in a PPLI, a private placement life insurance wrapper, so that then there's no taxes on the gains and the interest and everything that goes on in that portfolio to eliminate that money that comes back to the grantor.
Yep. There's a lot of different, that's where tax planning is very important at the trust level, just like it is the individual level, because obviously if you don't have to pay a $2.6 million income tax bill, you don't want to do it. So there's that piece. The other thing that I'll mention too is that it's really important that these irrevocable trusts have a reimbursement clause baked into the language. There has been some actual tax court cases that's very, very specific on if you are the grantor, you don't necessarily want to be forced to be saddled with the income tax bill every year. So best practice is that by default, the irrevocable trust is just going to have a reimbursement clause that essentially says, okay, the grantor is going to be paying the income tax bill, but that grantor can reach out to the trustee and ask to be reimbursed. So let's just say, because what if this entrepreneur here doesn't, eventually is worried they're not going to have enough liquidity to pay this $2.6 million. They could literally bankrupt themselves because all of this money is going and growing and compounding tax free within the irrevocable trust. That's where that reimbursement clause is very important, because if they're starting to get illiquid, they say, hey, I'll just call the trustee, I'll exercise this clause. Now the trustee will reimburse me for the marginal tax liability. So it's really important, that when you're putting documents together, that clause is in the irrevocable trust.
Very smart, and hard for a lot of people to understand sometimes when you say this person will never run out of money. You never know what's going to happen, and this also gives a lot of peace of mind for the entrepreneur to go, okay, I'll pay the taxes because I know I have that option that I can call in the future if I need to.
Yep. All right. So we call this tax burn. This is essentially again a feature, not a bug called tax burn. But there's definitely situations where this doesn't make sense. Now, normally mathematically, the math will tell you it makes sense for the grantor to do this, to pay the tax burn. But Jim, what are some experiences in your kind of when you go back through some cases you've worked on and when it makes more sense for the trust to pay its own tax bill?
Well, one of the ones that you mentioned, which is one of the biggest, is if there's a concern by the entrepreneur that they might not have enough money, you absolutely want to make sure that the irrevocable trust pays the taxes. I don't know. Did you have something else in mind? Nothing else came to
I think
mind.
The big thing I see is simplicity. To your point, you kind of alluded to this in the very beginning, that sometimes it's like, all right, I do all this planning, I set up all these irrevocable trusts, and it's like, oh, like every day or every year I get this 1041 and then I get this K1. I got to go pay these taxes for the trust. Like, it's just a pain in the butt, And sometimes it's like, hey, I just want to be done with my whole estate plan. The kids or my heirs are going to get enough money. Just let that trust handle itself. And I just want to move on. And I just want to consider this case closed. So that's not going to be generally the optimal approach on an Excel sheet, but life isn't lived out on an Excel sheet. And so that's, I'd say, the most common approach is it's just like, I don't want to deal with this every year. It's just kind of a pain.
And I do see this almost like a curve of the way things go with planning. Is when entrepreneurs first get a lot of assets, a lot of this planning sounds really exciting and they see all the benefits and then they start doing it. And then a few years go on and maybe 5 or 10 years go on and then they're like, you know what? I just want my life to be simple. If I need to have some go to charity, if I need to just, whatever I need to do, I don't want to be managing all this stuff. I just want to enjoy my life. And I do hear that a lot.
Yep. I think everything comes full circle eventually. So there is some planning you can do with the one big beautiful bill, right? With the SALT caps. We were talking about that, the state and local taxes. Instead of getting capped to write off $10,000, you can now write off up to $40,000, phased out at $500,000. So I don't necessarily think you want to do non-grantor trust status just to get around the SALT planning. You can do the same thing with QSBS. We've talked about that, 1202 stock. But those are the kind of the big things that I see of why you may not want to set it up this way.
Yeah, very true. Those are true. 500, 600,000 is the phase out for the SALT. Well, it shouldn't be phase out, phase down to 10,000, right? You keep your 10.